Welcome to the Q3 Investment Management Service update. So it's been a strong quarter in terms of returns, but there's still been a lot going on under the bonnet. So I'm here with John, who's going to talk us through what's been going on. So John, why don't you give us a quick recap?
Yeah, we've had elevated geopolitical uncertainty, which has clearly been something that's troubled investors. But I think more broadly, we've had, once again, resilient economic data, particularly in the US, and pretty solid corporate earnings delivery as well. And both of those have been the more dominant drivers of returns over the quarter.
Yeah, we've seen really good equity returns actually, and that's helped performance. We have, as we've talked about quite a few times, we have a small overweight position to equities within the JMFIN funds. So that's been a driver, and we've been expecting this strong nominal GDP growth and the good earnings to come through. So that really has helped performance. I think if I think about what maybe has been a slight detractor on a relative basis, at least, it's been the fact that we've been underweight US equities. So maybe you could give us a quick recap of what's been going on there, really.
Yeah, so there was a fairly measured and slower than expected rollout of tariffs in the US, and that I think enabled growth momentum to stay fairly strong. We had the effects of Trump's One Big Beautiful Bill Act, which was enacted in early July, and that does provide a significant boost for capex and R&D more broadly, so the investment cycle is very positive. And yes, US corporate earnings delivery under the AI narrative was also very strong. So we had a kind of reversal of what we'd seen in the previous quarter when the US did underperform.
And as we both know, multi-asset portfolios are not only about equities. One of the areas where we have seen good relative performance has been on our fixed income book, where we have had a shorter than benchmark duration position. So maybe you could talk us through, what the impacts there have been on the market and how that's fed through.
So we saw a Bank of England rate cut, but the Bank of England doesn't seem to be particularly encouraging in terms of further rate cuts, which I think is a mistake, and they probably will deliver more than the market's going for. So short yields fell, and therefore short bonds went up in price, but long yields rose, which meant that long bonds went down in price, and we've got a concern about UK fiscal sustainability, which isn't really going to be resolved until we go through the budget. So at the time being, long-dated bonds are under a little bit of a cloud.
So I think as we think about going forward, what's your views on kind of the market and positioning and outlook, I guess?
Yeah, so we've got a favourable liquidity cycle. Global money growth is outstripping nominal GDP, which is generally a tailwind for markets. We've got the prospects of a reasonable Fed rate cutting cycle over the next sort of 6 to 9 months. And we've also got the prospect of lower rates in the UK as well. So all of that, plus solid earnings momentum, reasonably resilient economic growth, and also fiscal reflation, I think, is a reasonably favourable backdrop for equity markets in the round.
Yeah, so it does feel as though the markets are slightly in nosebleed territory at the moment, and there's a lot of news and a lot of volatility going out there. And so we do think there will be moments when the more defensive parts of the portfolio need to do the legwork. But for the moment, we still see a reflationary backdrop, and we have a constructive view on equity markets and markets in general.